right? Let's say the top is 5,000. Are we going to get out of 5,000? No. But maybe we'll get out of 3,000 on the way down. But we would have bought a lot lower. And maybe we'll go. But the thing that you have to remember is you can't sell too soon. Because I talk to clients all the time. What if you have your goal and you bought it at, whatever you paid, and you get out at 2,000 because you think that's the top. And let's say you started with, let's say you end up and you cash out and you have $2 million, right? You cashed out and you have $2 million. And then the bottom drops out and the dollar collapses. And maybe you started with $1 million, or you bought gold with 1,000 and you sold it at 2,000. So you doubled your money, right? So you went from $1 million to $2 million. Right? And now the dollar collapses. See, people, I want to preserve my gains. I want to make sure I keep that extra million. Well, if the dollar collapses and chewing gum is $1 million pack, well, all right, you got 2 packs instead of 1, which is what's the big deal, right? So you can't be too early. You've got to make sure that the coast is clear. And what that means is you can't sell the top. Don't even expect to sell the top. In fact, there probably will be a blow-off at the end. And you can't know where that top is. You don't have to sell the top. Even if you sell, 70% of the top, it's way above where it is now. But you have to make sure that the government has done the right thing, that it's safe to go back to the paper. And we know what has to be done for that to be accomplished. And before that is accomplished, there's going to be a lot of economic pain. Much more economic pain than we had in 1981-82. It's going to require a much bigger sacrifice. It's going to require politicians to do things much, riskier than what was done at that period of time. So yeah, I'm hopeful that I will one day want to buy, U.S. assets again and paper, but we're nowhere near there. I mean, we're still early in the bull market for gold. We're still making mistakes. We're nowhere near correct.
So, what do you think South America and Asia, and is it best to access those markets through exchange traded funds or directly?
Well, I like to do it directly. If there was an exchange-traded fund that had the exact mix of stocks I like, I guess I would buy that fund. But I like to pick the stocks myself. I like to pick the stocks that are best positioned for the world the way I believe it will evolve. That's all about investing, is looking at the way things are. We're not looking at the way things are, we're looking at the way they're going to be. And so I want to buy stocks that I think are positioned for the world the way I think it will evolve into. And so I like to pick my own stocks. So that's what we can help you do, is pick the stocks that, based on my view, are the ones that you want to own, the countries that you want to own, and the currencies that you want to own. And it's not hard. I mean, it's a lot easier to buy stocks in foreign markets than it was years ago.
So you can't have a portfolio entirely filled with commodities with proper asset allocation for Canadians. Should it also include Canadian bonds?
I think individuals kind of have to decide for themselves, what they're comfortable with, what they want to do, what their circumstances are. There's no reason why you can't own Canadian bonds. I would not own long-term Canadian bonds. I do believe interest rates are rising, which means bond prices will be falling. So that to the extent that you want to have some bonds, keep the maturities no more than 2 to 3 years, and wait for rates to rise, and when they do, you can roll over into higher rates. But I think that there's better yields for people who need income. There's better yields to be had in equities, so I favor equities. But not all equities are the same. There are equities that are a lot less risky than others. So you look around and try to pick the kinds of equities and realize that if you can do the deal, you can take the volatility. And what a lot of people don't understand is, let's assume that you need 7% of your money to live the way you want to live. Well, you can't really get that in the bond market now. You might have to just, take 2 or 3% and just put it into the principal every year. Well, that's a loss, so why not just buy stocks? And if the price of stocks goes down, it's okay because you're getting a yield. And if you're buying good companies, years from now, the stock prices will probably be quite a bit higher, even if they potentially go down in the interim. But meanwhile, if you're buying for the income, it doesn't matter if the stocks are priced, as long as you're not selling. And a lot of people are afraid, I don't want to buy this, it might go down. So what? Who cares if it goes down? And as long as you buy it at a good price, it doesn't matter if somebody else buys it at a better price. What matters is you didn't overpay, you're getting a good dividend. And have no reason to sell the stock. Why would you sell it? Because you have to replace the income. You know, so you're not going to sell it. So people have to psychologically get used to the fact. You know, and people, and the thing about stocks is they're publicly traded, so you can actually see what they're worth every day. People would go crazy if, you know, their house was publicly traded and every day was a price there. But nobody cares what their house is worth day to day. You know, I mean, it doesn't matter. So the fact that these stocks are trading, you know, we do a lot of private investment for clients. You buy a stock and it's never trading. It's a convertible preferred, so they never worry because they never see the price change. But, theoretically, the value is changing every day even if there's nobody transacting.
If the U.S. does go through a period of significant inflation or even hyperinflation, how will that immediately affect Canada?
Well, again, I don't know, and a lot of it depends on what Canada does. You know, there will be some aspects of the Canadian economy that will be hurt. There's others that will be helped. You know, certainly, you know, anything imported from America will get a lot cheaper. There won't be as much exported to America, but whatever you do export, you get a lot more money for it. And you know, there might be, if other currencies are rising, so your shipments will go to other countries, things are going to change. But you don't have to have a wealthy country on your southern border. We got Mexico on our southern border. No. So maybe Mexico is going to extend all the way up to Canada.
So Europe is in trouble. Do you think the euro will hold or remain a viable currency and perhaps even alternative to it?
Well, it's certainly an alternative to the dollar now. I don't think 100 years from now the euro will exist in its current form. 50 years from now, it probably won't exist in its current form. 5 years from now, probably. You know, I think the euro is flawed in the way it's set up, and politically, I don't think it will last. But it may outlast the dollar, at least in its current form. You know, Europe has a lot of problems. What Europe should have done was the first problem that happened in Greece. They should have let Greece default. There should have been no bailout for Greece, and that would have set the euro up to replace the dollar. It would have created, initially the euro would have sold off and then would have had a huge rally. And it would have been great for Europe, it would have been great for Greece, it would have been good for Ireland, it would have been good for Portugal, it would be good for all these countries that would be allowed to default. Because the people would not be, you know, debt slaves, and the creditors would lose money, and that would be a good thing.